pips, the tiny unit every forex trade is measured in. Miss the math, you're guessing. Here's how.
A pip is the smallest unit a forex quote moves in, and if you can't turn it into a dollar figure in your head for the pair you're trading, every position you take is a guess. In the next few minutes, you'll learn exactly where the pip sits on any pair, how much it's worth on any lot size, and how to use that to size trades so a 1% loss really is a 1% loss. First, do this. Open MetaTrader or cTrader, the trading software most retail brokers run on. Pull up EUR/USD and look at the price, 5 digits after the decimal. But every tutorial talks about pips at the 4th decimal. So what's that 5th digit doing there? Hold that thought, we'll come back to it. Pip is short for percentage and point. It's the smallest standard price increment a currency pair moves in. On most pairs, that's the 4th decimal place. EUR/USD ticking from 1.08510 to 1.08520, that's a 1 pip move. GBP/USD, AUD/USD, Euro/GBP, same rule, 4th decimal. It's not a law of nature. It's a convention interbank dealers settled on decades ago because that was as much precision as anyone needed. The reason it matters today is simple. Every stop loss you set, every spread your broker quotes, every risk calculation you'll ever do, all of it is spoken in pips. Get the pip location wrong and every number downstream is wrong too. Back to that 5th digit. It's called a pipette, and it's 1/10 of a pip. Most modern platforms, MT4, MT5, cTrader, the apps from OANDA, IC Markets, Pepperstone, IG, quote to 5 decimal precision on non-JPY pairs and 3 decimal on the yen ones. So EUR/USD at 1.08515, that trailing 5 is a pipette. Here's where it gets sneaky. When a broker advertises spreads from 0.0 pips, they almost always mean 0.0 to a couple of pipettes. A 0.2 pip spread is really 2 pipettes wide. Think of a pipette as a cent to a pip's dime. Still tiny, but when you're comparing 2 brokers and one quotes in pips while the other quotes in pipettes, you're not comparing like for like until you translate them. Now the trap that catches almost every beginner, yen pairs. Any pair with JPY in it, USD JPY, Euro JPY, GBP JPY, AUD JPY, the pip lives at the 2nd decimal place, not the 4th. USD JPY moving from 154.20 to 154.21, that's 1 full pip. The pipette on yen pairs sits at the 3rd decimal. Why? Because the yen is worth a much smaller absolute amount than the dollar, so the convention shifted the decimals to keep price movements at a workable scale. Here's the practical consequence. A 20 pip move on USD JPY looks visually tiny on the chart. The price barely wiggles, but in dollar terms, it's roughly the same size as a 20 pip move on Euro USD. Same word, same number, completely different looking chart. This is exactly why you can't take a stop loss distance that works on Euro USD and paste it onto USD JPY without resizing. So how do you turn pips into actual dollars? 3 cases cover almost everything you'll trade. Case 1. USD is the 2nd currency. Euro USD, GBP USD, AUD USD. This one's clean. Multiply the pip decimal by your lot size and you're done. One standard lot of Euro USD is 100,000 units. So 0.0001 times 100,000 equals $10 per pip, meaning every 1 pip move up or down puts $10 into or out of your account. Mini lot, 10,000 units, is $1 per pip. Micro lot, 1,000 units, is 10 cents per pip. Case 2. USD is the 1st currency. USD JPY, USD CHF, USD CAD. Now you have to divide by the current quote to convert back into dollars. One standard lot of USD JPY at 154.20 works out to about $6.49 per pip. Case 3. No USD in the pair. Euro GBP, GBP JPY, AUD CAD. Same math, but you compute in the quote currency first, then convert to dollars using the current exchange rate. Your platform will display it automatically, but if you can't back into it by hand, you'll get blindsided the first time you switch brokers. Let's make this concrete. On Euro USD, memorize 4 rows and position sizing becomes instant. Standard lot, 100,000 units, $10 per pip. Mini lot, 10,000 units, $1 per pip. Micro lot, 1,000 units, 10 cents per pip. And nano lot, 100 units, 1 cent per pip. Though nanos are rare outside brokers like XM and FBS. Here's the workflow. Pick the dollar amount you're willing to lose on the trade. Divide by your stop distance in pips. The lot size falls out. That's it. That's the whole system. Pips give you a common unit that translates chart movement into account currency dollars. Lot size scales that unit up or down. Pips aren't just how price moves, they're how forex traders price the cost of trading. Take a typical ECN account, which just means a raw spread account where you pay a small commission for the tightest possible price. On Euro USD, the raw spread might be 0.2 pips, plus a round turn commission of about $7 per standard lot. Added up, you're starting the trade roughly $9 in the red, meaning the price has to move about 0.9 pips in your favor before you're even at break even. Anything below that is a loss before slippage or overnight financing enter the picture. Compare that to a commission-free standard account where the spread might be 0.6 to 1.5 pips. It looks cleaner, no commission line, but the cost is baked into a wider spread and you're often paying more per trade, not less. Same trade, two accounts, different math. Always price your trades in pips and dollars before you click buy. Now the full worked example end to end. Euro USD is at 1.08500 and you expect to move up to 1.09000. That's 50 pips of upside. You're on a $10,000 account and you follow the 1% rule, so you're risking $100 on this trade with a 20 pip stop. Position size math. $100 of risk divided by 20 pips of stop equals $5 per pip. On Euro USD, $5 per pip is 0.5 standard lots, 5 mini lots. Stop hit minus 20 pips times $5 equals minus $100, exactly what you sized for. Target hit plus 50 pips times $5 equals plus $250. That's a 2.5 to 1 reward to risk on the trade, meaning your strategy only needs to win about 30% of the time to grind out an edge. This is why pip math isn't optional. Once you've committed those 4 lot size rows to memory, every chart is implicitly priced in your account currency. A quick tour of the traps. 1. Confusing pips and pipettes. A broker quoting 5 pip spread is often 5 pipettes, which is half a pip, 10 times cheaper than you thought. 2. Using identical pip counts across pairs without resizing. A 20 pip stop on Euro USD and a 20 pip stop on USD JPY are wildly different chart moves. 3. Ignoring pip value drift on crosses. If your account is in dollars but you're trading Euro GBP, your pip value shifts as the euro moves against the pound. Small drift, real dollars over hundreds of trades. 4. Chasing daily pip targets instead of percent return. Pips are a distance unit, not a profit unit. A 20 pip win on a micro lot is $2, not a career. And 5. Metals, indices, exotics. Broker-specific pip definitions. 2 brokers can both say 1 pip spread on gold and mean different dollar amounts. Always read the instrument specs. Here's the bigger picture. Pip, lot, leverage, margin. That's the chain every forex trade sits on. Pip gives you the measurable unit. Lot size converts it to dollars. Leverage lets you hold a position bigger than your cash on deposit. Margin is what the broker locks up as security while the trade is open. Pip math is the foundation the other 3 sit on top of. And remember that 5th decimal on your chart at the very start? That's not decoration. That's your broker's cost showing up in pipettes. And now you know how to read it, quote it back, and check whether the spread being advertised is the spread you're actually paying. Get pip math tight and everything downstream, spreads, leverage, margin, position sizing, cost comparison across brokers falls into place. Get it loose and you're guessing with real money on the line.
Now you can read any forex quote in dollars. Check the description for the complete breakdown.